Hello class, this is Brian from financialtrainingschool.com and welcome to GT214 Traders versus Investors. So the primary difference between traders and investors is the time horizon of the trades that they're making. Traders tend to care more about short-term gains, and traders can be split into two groups of traders: day traders and swing traders. Day traders usually trade extremely short-term time horizons, so between a few minutes up to a day max, and that's why they're called day traders. So they close all of their positions by the end of day one and they start day two with a new mindset. They're also sometimes called scalpers as well. Swing traders, on the other hand, unlike day traders, they have more patience in that they're willing to wait up to a week or even a month for a bigger payoff. But traders in general, as I cover in GT303 diversification, are typically risk lovers. More risk usually translates to more headaches as well, because you're trading in the short term. You need to pay attention to everything that happens in the immediate future, and you care about that short-term gain. Unlike investors, who have more patience and can wait for long-term gains. And investors are typically more risk-averse, so in exchange for less risk, they're willing to wait for longer-term gains. With less risk involved, they don't have to worry as much as traders unless something big like news comes out. So news can be good or bad depending on who you are. Traders love news since it provides volatility, giving more trade opportunities. In addition, news is sometimes referred to as a catalyst because it provides the means to push the markets to new highs or new lows. Investors don't care much for volatility or news because it's kind of just noise in the short run, but they do care for updates from the asset that they're invested in. They need to make sure that their money is still safe because they're risk averse. After all, they're invested in the asset due to fundamental reasons. So for instance, in stocks, the company might release a new product line, or profits are up, etc. In Forex, a country could have higher employment, GDP, or low inflation, or the bank interest rates have changed, etc. Something like that. So that's it for this lesson. I know it's relatively short. I just briefly wanted to cover time horizons for different trader types because this will be elaborated further in the Forex series and the stock series and all of the other trading series to come in the future as well. So I'm going to end off the lesson by providing a visual example of what I meant by time horizon of day traders, swing traders, and investors. So here we go. This is free stock charts, and we're currently looking at the Apple stock chart. Let's just say we start on this black line. This is November 16, 2010. And let's say we start trading on the 18th. So on the 18th, the open of this green candle, everybody enters. So the day traders enter, the swing traders enter, and the investors enter. They all enter at the same time. But now the difference comes in depending on when they exit the trade based on the time horizon. So the day traders are going to exit around 3:08. So they entered at 3:05. They're taking a $3 profit for the first day, and then they trade the next day, and then the next day, and the next day. These are all daily candlesticks, by the way. So swing traders will be longer than that. So swing traders will hold past this day, past this day, past this day. Maybe they'll hold for a month, or maybe the end of the year, because it's November right now. So let's say they hold for until the end of this year. So let's go to December 31st. December 31st is the black line right there. So let's say swing traders exit up here. So they exit around, 3:22. They entered at 3:05. So that's a $17 profit. So swing traders will have the patience to trade this long to get a $17 profit, whereas day traders will just trade each single bar by itself. They'll get $3 this day if they went up, or they might lose $2 on the red candle, or they might win here $6 to there. They make another $7 on this green candle, etc. So these are short-term traders. That's why they're called traders. Whereas investors, since they're investing for fundamental reasons, they know that Apple is a fundamental company. Let's say that investors are holding for a year. So let's say they hold until the end of 2011. So they got in on this lower red line here, and they're holding for a year, which is up to the next black line right there. So they're holding, they got in at 3:06, 3:05, and they got up to 4:08. So that's a $102 profit, or $103 profit. Whereas swing traders would be trading like the bounces, so like a bounce from here down to there, and then a bounce down here up to there, etc. And then the day traders will trade each individual bar by itself. And then zooming out further, maybe the investor thinks long term, they're just going to hold it forever. So let's just zoom out, and then it goes up some more, and they're holding up to here. So up to here, the high I think was like $700 or something. Or yeah, it was right here, $703. So if they held to there, they would have doubled their money, more than doubled their money actually. That would have been a $400 profit, which is about $150 33% profit. So the whole point of this video is just to outline the time horizon, because when I get into the Forex series, we're going to be looking at time horizon of trades. Either you want to get a big position and hold it for a long time, or just enter every day and trade short term. So that's it for this lesson. Hope you guys enjoyed it, and I will see you guys next time.